What's going on, guys? In today's video, I wanted to discuss a couple of good questions that I got on how I trade credit spreads and go over some examples of actual trades that I have on currently and basically use those as good background examples to show you what's actually happening in my account and how what we're discussing and what we're talking about relates to real trades. So I hope you enjoyed the video, and if you do, make sure you drop a like down below, and if you want to see more videos like this one, make sure you hit the subscribe button. So this first picture I have up here is just my account balance. So this is the account that I'm actually trading options on. Basically, I just use this account for more short-term trades, options trading, things like that. Well, I do have a longer-term account that is actually much larger than this account. So you can see I've got a total of $18,500 in this account. We were up almost 1%, which was a little over $150. The market itself was actually up 1.63%, and really a lot of my kind of dragging stock was actually Rocket, which was down 2% on the day. The rest of the stocks were kind of green in here. IVR running the wheel on that. That's a mortgage company. Rocket Mortgage, also a mortgage company, so a little overexposed there, but running the wheel on that. And then SoFi running the wheel on that. So I do have videos on Rocket and SoFi, so I'm putting my money kind of where my mouth is and actually trading the stocks that I'm talking about. So I hope you guys appreciate that kind of insight and look into my account. But let's go ahead and get into some of the questions. So basically we have two questions here by a guy by the name of Joshua Brown. If you're watching this, awesome, make sure you hit the like button, Josh. But basically what he's asking in this first question is, how often am I actually putting trades on? So he's saying, how often am I putting trades on? If you're making $200+ a month, you must be basically putting multiple trades on if you are only getting a $25 return on every trade for 45 days. So basically what we're looking at, right, is my response to Josh's question. So in my trading, basically you can go back and watch my how to trade put credit spread video, and that kind of goes over some of my strategy. But basically, to run it down, I'm trading put credit spreads, and I actually only am collecting around $15 per trade after everything kind of works itself out. So on the front end, when I first place the trade, I'm kind of targeting a 0.1 delta, and what that comes out to and what I generally collect on that is around $20, and that's after TD kind of takes their commission fees for options trading. And then on the back end, so after everything kind of plays itself out, after theta decay takes over, I generally close the trade for around $5. It ends up being around actually closing at $3 plus the commission, which comes out to like $4.32. So I rounded that up to basically $5. So there you're looking at a $15 return. And what actually ends up happening is I only end up holding the trades for probably somewhere between 25 and 30 days. What I kind of said in here is I do need to do a better job of tracking it. So I'm hoping in the next kind of few months, kind of as we start the new year, that's kind of one of my goals, is to actually track how many days I'm actually holding these trades. But I would guess that it's probably around 25 to 30 days, unless you run into situations where volatility spikes after you put the trade on. So recently that's kind of what we ran into, and that's why I put this sad cry face here, is because obviously the market has dipped a lot. A lot of the small caps kind of have experienced a lot of volatility and drops in their stock prices. And in doing that, right, that increases the volatility of the overall market, because the market kind of is dropping and then bouncing up and then dropping and then bouncing back up. So as it does that, right, volatility goes up, and right when volatility goes up, basically my trades are not they're hurt, you could say. Basically I have to hold them longer to be able to get the decay that I need. So obviously if the market kind of starts trending back upward, volatility tends to decrease, and then I can basically, as it contracts, start closing these trades again, which is kind of what's happened over the last week or so. A lot of the trades that I put on in December, basically when the volatility spiked, I had to keep them on until basically a week before expiration. So those trades I did have to hold almost to expiration, just because of the volatility increase that we saw there. So Basically, what I'm getting at to answer Josh's question here is, so I'm making around $200 a month. You can go back and see my portfolio videos. I'll do an end of the year portfolio video probably here soon. And I'll release it on the channel, and then I'll go over all my returns and everything. But what we're looking at is about 13 to 14 trades per month, basically. So what that comes out to, right, is if you're taking the $200 that I'm saying I'm making per month and divide it by $15 per trade, basically that I'm collecting after everything's said and done, that comes out to 13.333 trades. So basically, right, I'm trading around 3 to 4 times per week, putting trades on. Obviously, if volatility is higher, maybe I'll put on 5 to 6 in a week, so one kind of every day. And if volatility contracts and basically we're not in a very good position to put trades on, then I will put less trades on. So there's kind of a fine balance. So there's no exact number. And then he kind of he said he wasn't kind of questioning the validity of it, but I wanted to kind of give him some bonus info. So a lot of these trades, or basically all the trades that I'm putting on, are $5 wide spreads. So really, in reality, right, to hit 14 trades, you just need to take 14 multiplied by the collateral that you would need to put those trades on over a month period, right? You'd tie up all your collateral, all your capital, and that only comes out to $7,000. So you would only, in theory, need $7,000 to basically trade, to be able to trade 14 times in a month and make $200 a month. So really, it doesn't come down to a whole lot of money to really kind of get started, but I would obviously recommend starting at a smaller amount, kind of learn kind of what your trading strategy is, how you want to do things, and then kind of scale up from there. So then Josh had another question the other day, and basically that question was, when the trade goes against you, how do you basically manage the trade? Do you use a stop loss target, or am I always rolling my trades? And this was kind of on my video about how to roll your trades and basically why it's very important. And my answer was, basically I'm looking at delta. So I'm looking at the overall delta of a stock. I'll pull up an example here on kind of the next slide, but I'm looking at delta to make a decision. So when delta, right, I put my trade on at a delta value of 0.1. So as the trade, as volatility increases and the price potentially moves against me, delta is going to increase. So what I'm waiting for is, I'm waiting for delta to hit 0.3, and then 0.3 is basically my target, and it says, okay, this is the target for when I need to make a decision. So at that point, I need to make a decision, and my decision is either going to be roll the trade or close the trade. So, and then, right, those are two different paths. And that's where the mindset kind of comes in, where you need to make a decision based off your feel towards the market. So if you feel the market is going to turn around and go basically back up, and maybe it's going to go back up in the next couple weeks, the next month or so, then your better option is going to be roll the trade, right? Because in reality, you're probably going to turn around if you're doing the strategy and kind of using it over and over again. You're going to put a trade on anyways, so just roll the trade out, collect enough premium to offset kind of any losses that you might be incurring, and just kind of continue on with your way and keep monitoring the trade, right? Because in theory, you can kind of roll just to infinity, basically, right? As long as no one exercises their trade, exercises your sell against the market in your spread, then really you're fine. And if you don't let it get into the money, then no one's ever going to exercise their trade, right? So you're never really in trouble. So you can put the spread on, right? And as long as you're managing it before it goes in the money, you should basically always be fine. It's just a matter of how many times do you want to roll the trade, basically, because you might have to roll it out very far in time, and then kind of have to deal with continuing to roll it out even further and further in time. So that's kind of where you get with rolling, but that could be a whole nother video on things like that. Let me know if you want to hear me talk about stuff like that. But The other option is obviously cutting your losses. So if you think the market is going to keep going down, then it never makes sense to basically hold on to the trade, right? If you think it's going to fall, if you think you'll roll it out and it's going to just go blow past your strike and you'll be in the money and basically be in big trouble, then it just makes more sense to cut your losses, wait a week, kind of don't put any trades on, wait a week or two until you feel more confident that the market's hitting a bottom. And then once the market you think is close to a bottom, start putting on trades again. Because in theory, right, if the market is dropping and you think it's going to keep dropping significantly, in theory, volatility should keep going up as the market is going down, because it's just, there's more and more volatility, more and more fear basically in the market. So basically you'd want to take the trade off, right? Let volatility keep increasing so you can get even further out of the money and collect even more premium basically for your spreads. So that's kind of the thought process in there. This year, the other comment I have in here is this year, I have actually never had to basically make a decision. I've never hit a 0.3 delta on any of my trades. Again, I'm trading so far out of the money at 0.1 that it's never been a challenge. But based off kind of what I've seen, I've gotten up to around a 0.25 delta. And based off what I'm seeing is if I ever had to close it for a loss, I'd probably be around $200 to $250 for loss. So that's a 50% loss on your trades. And that's why you want to diversify. You don't want to put you don't want to buy 5 of a single spread. You want to kind of spread them out, different strikes and different time periods. But yeah, that's just a overall good kind of thing to look at. And basically that goes over how I look at closing the trades if I'm ever in trouble. So the last thing here I wanted to look at, I wanted to be able to give you guys real examples of trades that I have on. So you can see just a few of the trades that I have on. I haven't counted how many I have on right now, but these are some of the January ones that I've been putting on the last couple weeks. So you can see this spread is probably 400 to 405. Obviously it got cut off there, but then you have 395 to 400 here for January 7th, so that's 23 days out, and then you have January 14th, which is 415 to 420 spread in there. And really what I wanted to focus on here is this column here. So this is delta. So right, normally I'm putting the trade on at a 0.1. So these have lost basically a lot of delta. So basically the reason for that is, right, there's been a lot of, it's not, normally you'll get a lot of time decay, but these ones specifically I put on when there was a lot of volatility. As volatility contracted, so did the delta. So right, that's basically this, and I'll jump over to price here in a second, but basically you're seeing these numbers fall off a lot. And that's the perfect situation, right? You put on a trade in a high volatility environment, delta or volatility contracts, and then basically your price drops significantly, and you can close your trades a lot quicker. So again, that's looking at the January 7th one. This is actually my worst trade in terms of this is the closest to the money strike that I have on right now with the furthest expiration. So right, we're at 420. The overall market I think is around 460, 465, kind of somewhere in there. But what you're seeing is that's a 0.07 delta. So again, I put this on around a 0.1. So in just probably less than a week, it's already contracted down to 0.07. So that's a good sign overall. And then you've got the maintenance in here, right? Because they're $5 wide. You can see we're sitting at $500. So let's jump over quick and look at the actual price of the spread on these two trades. So here we have the price of those two trades. So again, the January 7th and the January 14th, 420, 415, 400, 395. Just FYI, this is my account name, so I just crossed that off if you're wondering. But basically what you're seeing, right, so that one where we saw the biggest contraction, where we're at a much lower delta, what was it, around a 0.2, we're seeing that the difference in this price is the cost of the spread. So if I wanted to close this trade, right, you're sitting at $5. So to close this trade, basically I would have to pay $5. So what I do is I wait for basically the difference between these two numbers to get down to around $3, and then I would close this trade and be able to close it out. So this one's actually fairly close. Maybe in the next week, if the market bounces up and continues to bounce up, I would expect volatility to continue to contract, and I might be able to close this week, or hopefully next week. And here, like I said, this is my worst trade in my account because I'm closest to the money for this expiration. And here we're actually at $19. So this trade, you remember, we were sitting at a 0.07 delta. So right, that's we're still a ways out for this one to kind of get closed. Hopefully the market doesn't drop and we run into kind of trouble on this one. That would be the only thing that I'd be worried about. But honestly, I think as we get into January, I think things are going to kind of turn around. People will start getting excited about earnings season. I think with kind of all the holidays and people spending a lot of money and whatnot. So I'm not too worried in this position. Worst case scenario, I roll it or I close it, you know. So it is what it is. But anyways, I hope you guys appreciate the transparency. If you have any questions kind of similar to stuff like this, let me know and I'll make either a video about it. I'll definitely answer your question in the comments, and then I'll potentially make a video about it and kind of hopefully give you more insight to my thought process behind these trades. So if you did like the video, make sure you hit that like button down below. And if you want to see more videos like this one, make sure you hit the subscribe button. Otherwise, have a wonderful rest of your day.